So let's talk about fixed income, because you and I were swapping notes about that. I think there's some amazing charts currently. You know, they're slightly shorter term than the big picture charts we've been looking at, but they look really interesting. What's your thoughts?
You know, there are longer term charts and there are shorter term charts, but then there are just some asymmetric trades that are just sweet. You know, and you can give me that off of a monthly chart, or you can give me that off a 6-hour chart, but asymmetrical is asymmetrical. And so, yeah, the charts indicate to me, and they've indicated to me for a very long time, that the U.S. is going to join Western Europe with negative interest rates. That's the stories the charts told me. When I look at 5-year yield charts, when I look at 10-year yield charts, when I look at Eurodollar charts, it's telling me we're going to minus 20 to minus 30 basis points. They all target that area. That's where I think we're going. We'll flatten out the yield curve, but with perhaps the tail end of it, the long end will retain some sort of yield to it. But generally speaking, I want to be long 5-year notes, futures. I'm talking futures now. I want to be long the 10-year. I want to be long the ultra notes. I got a buy signal today in the bonds. Went with it. We're going to get buy signals in the euro. So yeah, again, it's a shorter term play. But hey, I'll take money when they put on the table, whether I have to reach my hand and keep it there for a year, or I can put it on the table, grab the money, and remove it immediately.
Well, because look, I mean, in simple terms, I see that the long-term chart patterns all look like they're going to negative rates. We know that the Fed desperately needs rates to get to zero. They've been a little bit sticky recently after the first bout of stuff and the illiquidity in the system. So when I look at that 5-year note, I mean, it's a perfect chart pattern here, and it fits the narrative of what the Fed want. The Fed are in your favor here. It's not like shorting stocks where the Fed are trying to do the opposite to you. The Fed are in your favor. We've gone through all of these charts about the potential disinflationary pressures and stuff like the dollar. It just looks like it's an amazing setup.
Oh, it does. You know, it looks a little bit like it did back in mid-January. You know, we had some wonderful buy signals in the Treasury futures, you know, back mid-January. I mean, there were extremely low risk spots to get in. There was some significant upside targets that we're looking at. It was an easy play. And then again in mid-February, we had an easy play. It was a layup. There were layups. You called the euro just wonderfully well. In all of the interest rates. Well, I think we have a pretty similar thing right now. And we have a lot of people that don't want to believe it. That's what I like about. You go and put out on Twitter that the charts all look like we're going to a negative interest rate policy in the U.S. You'll get trolled like crazy.
I mean, I did exactly that, and I got trolled like crazy. Everyone said, can't you see it's hyperinflation? I'm like, I understand your narrative, but the charts don't tell me that. Nor does the dollar, nor do the commodity markets, nor does anything, nor does the equity market. So I understand why you might think it's hyperinflationary, but I don't see it in the charts. It looks like we're going to deflation.
Well, it does. You know, I always come back to something I once heard Paul Tudor Jones talk about, and that is it's at that last leg of a market where it's easiest to pick up money. You know, it's that last thrust. And so, yeah, they may be right that all of this printing press money is going to eventually take us to higher rates in the future, higher yields in the future. That may be true. But, you know, sometimes when you're too early with an idea, the market will punish you. And also in the back of my mind is the fact that this could be everyone has talked about the big blow off. We've been in this big blow off since, you know, the early 1980s toward lower yields. And, you know, maybe this is now finally the blow off that takes us from where interest rates were back in 82, 83, 84 to now finally where they go with the negative interest rates. But the charts all indicate to me that in the short term, the risk is in being short Treasury futures, not in being long Treasury futures.